So, today we're going to dive into the world of the stock market and explore two of the most widely recognized indices, the Nasdaq and the S&P 500. These indices are used as benchmarks to gauge the health and performance of the overall stock market. Let's start with the Nasdaq. The Nasdaq is an acronym for the National Association of Securities Dealers Automated Quotations. It's an electronic exchange that was founded in 1971, and it primarily focuses on technology and growth companies. The Nasdaq is comprised of over 3,000 companies, and it's known for being a high-tech trading platform that operates completely electronically. This means that there is no physical trading floor like you might see in the movies. One key characteristic of the Nasdaq is that it's dominated by big-name technology firms such as Apple, Microsoft, Amazon, and Facebook. These companies make up a significant portion of the index, so any changes in their stock prices can have a substantial impact on the direction of the Nasdaq as a whole. Tech companies are often associated with innovation and rapid growth, which is why the Nasdaq has gained a reputation for being a higher-risk, higher-reward exchange. In terms of market capitalization, or market cap, the Nasdaq tends to have a higher concentration of smaller companies with relatively high valuations. This is due to its focus on the technology sector, which tends to have a lot of startups and fast-growing firms. These companies may have a smaller market cap compared to well-established companies in other sectors, but they still have the potential for significant growth. Now, let's turn our attention to the S&P 500. The S&P 500, also known as the Standard & Poor's 500, is a stock market index that includes the 500 largest publicly traded companies in the United States. These companies span across various sectors, including technology, finance, healthcare, and energy. Unlike the NASDAQ, the S&P 500 is not limited to technology companies only. It aims to provide a more comprehensive overview of the entire U.S. stock market. While the Nasdaq is dominated by tech giants, the S&P 500 includes a broader range of companies, which makes it a more diverse index. This diversification helps reduce the overall risk associated with investing solely in a specific sector. So, if tech stocks are experiencing a downturn, chances are other sectors within the S&P 500 may be performing relatively better, thus potentially balancing out the overall index performance. Another significant difference between the Nasdaq and the S&P 500 lies in their selection methods. The Nasdaq uses a market capitalization weighted index, meaning that companies with higher market caps have a greater impact on the index's movements. In contrast, the S&P 500 uses a different methodology called a float-adjusted market cap. It takes into account not only the market cap of a company but also the number of shares available for public trading. This methodology provides a more accurate representation of a company's value in the index. Now, when it comes to performance, the Nasdaq and the S&P 500 can have different growth rates and returns over time. Since the Nasdaq is heavily reliant on the technology sector, it tends to experience more volatility. This volatility can lead to rapid rises during periods of growth or sharp declines during market corrections. On the other hand, the S&P 500, with its diversification, tends to be less volatile as it is influenced by a wider range of sectors. This stability can appeal to investors who are seeking a more balanced approach and are willing to sacrifice the potentially higher returns of the Nasdaq for a smoother ride. Ultimately, both the Nasdaq and the S&P 500 have their pros and cons. The Nasdaq offers the opportunity for significant returns but comes with higher risks. On the other hand, the S&P 500 provides diversification and stability but with potentially lower returns. The choice between the two depends on individual investment goals, risk appetite, and time horizon. Some investors may choose to include both in their investment portfolios to take advantage of the different characteristics and benefits each index offers. In conclusion, understanding the differences between the Nasdaq and the S&P 500 is crucial for anyone looking to navigate the stock market. While the Nasdaq focuses on technology and growth companies, the S&P 500 offers a broader representation of the US stock market. Both indices have the unique features, performance patterns, and risks. By grasping these differences, investors can make more informed decisions and align their investment strategies with their individual goals.